Hi, folks. Can everyone hear me clearly? Are we good at the back? Awesome. Well, thank you, everyone, for being on time, and we're excited to get this session kicked off. So my name is Shirin. I'm with the World Economic Forum. I lead our program on natural capital, which is part of a broader set of work we do on financing for nature. And I'll get into that in a second. But I just wanted to share what our agenda for this 90 minutes is. So we'll give a short introduction on what the context for this session is and why we've decided to put it together. We'll spend most of the time, thankfully you don't have to listen to me for too long, you'll be listening to them for the most of it. We'll speak with them for about 45, 50 minutes or so. And then slightly different to how some of the other sessions have gone, we're going to go into breakout groups. And a bit more on that later, but the idea is to go slightly deeper on some of the discussion points. It also gives you a chance to speak with our panelists in a little more intimate setting. And then we'll close off with about 5 minutes to go, just hear your reflections on how the discussions went. But let me quickly ask a question before I get into this. So how many of you have heard of the World Economic Forum? Just raise your hands. Okay. Clearly, that's expected. But who here knows what we do beyond our annual meeting in Davos? Much fewer, as expected as well. And that's sort of where I'm going to start the presentation. So we have 11 centers of work at the World Economic Forum, and they're up there. I won't go through each of them. But there's two that I wanted to point out today. So one on the left-hand side there, financial and monetary systems. This hosts a few of our really, really interesting communities on banking and capital markets, investor industries, so basically including all of your institutional investors and asset managers. And being a partner-based model, our job as the World Economic Forum is to service them, service their leadership needs, their thought leadership needs, their engagement needs as they go through a variety of different agendas, whether it's sustainability related or otherwise. And then the center highlighted in blue, that's the center where the work that I do sits, the Center for Nature and Climate. It sort of sits underneath as a sort of topical center. And there's a number of agendas that we explore as part of that. So there's an Earth systems agenda, there's one on economy, there's one on industry transition specifically, and there's one on people-focused transition, so basically food and water systems. And maybe let's dive a little bit deeper into that session, into that center. As mentioned, we have a pretty interesting program on financing for nature. At the World Economic Forum, I think there's over 20 colleagues working on that specifically. And if you boil it down, there's really three key priorities that we pursue. The first is sort of mainstreaming natural capital in global socioeconomic systems. So the idea being you bring nature-related data into decision-making for investors, businesses, and governments. And that's a program that I lead. The second one, and this is a really interesting one that's been expanding a lot recently, is supporting the finance sector specifically, so that's banks, asset managers, insurers, in understanding what nature positive means for them. And Rob, who's on the panel here, has been, with Oliver Wyman, has been a really keen supporter of that work. So we've done some very interesting work on a corporate assessment framework for nature positive transitions that came out earlier this year. And we have some very interesting financing blueprints coming up soon as well. And then finally, we have a few initiatives that focus on championing nature markets and innovative finance solutions for nature. So now you're starting to see a little bit where this session is coming in, but this piece of work began with, say, biodiversity credits, water credits, and is expanding as the market is expanding. And just again, to situate the context in which we're having this discussion, there's about 5 key trends that the global nature finance agenda is kind of going through at the moment. This is, strictly speaking, our viewpoint. But to start off with, there seems to be a very interesting convergence around different agendas at the moment. So the lines between climate, nature, resilience are quite blurring. From nature-based carbon credits to thinking about supporting a just transition for the commodity sector producing communities, to even thinking about urban resilience through urban restoration and those sorts of topics. And of course, the COPs as well seem to be integrating a fair bit. So COP30 this year in Brazil has a pretty interesting program that has focus on nature in more sort of terms than ever before. The second is that there are building policy signals that are helping develop markets. They're not quite there yet, but they're getting there. Everything from NBSAPs getting a little bit more specific on what the financing angle is. Part of the GBF is that's the Global Biodiversity Framework, is to mobilize $200 billion in capital, even though a lot more is sort of needed. But you also see a lot of activity on disclosure frameworks from TNFD. Maybe not a taxonomy anymore with the news from the EU earlier this week, but you have the Gore bond standards. You have the nature credits market that they have recently released a roadmap on. So there's quite a bit building. Institutional capital is also moving. It's really striking how 3 years ago, even maybe 18 months ago, the conversations that we were having on nature were focused on the why. Like why must we invest in nature? What's the point of it all? Where is the resilience coming in? Now the conversation has squarely turned to the how, which is, so what are the mechanisms in which one can invest in nature? What are the economics of some of the projects underneath that? So it's very interesting that that's coming at the institutional level, of course, your sovereign wealth funds and pension funds, but it's also coming at the other end of the spectrum. So your VCs and private equity firms are really interested in some of the tech-first models, for example, that are underpinning this transition. On that note, there's an acceleration of the nature metrics debate. I won't sort of bore you with that at the moment, but we all know sort of the challenges around that. And finally, there is, based on all of this, an emergence of new asset classes and markets from ecosystem service markets, biodiversity credits, natural asset companies that are really showing good promising signs. But the point is that they're kind of confusing everyone right now. And that's where we come in. So we have a piece of work coming out in September that was, shall we say, built with the industry, with investors, asset owners, and asset managers, for the industry to sort of understand this landscape better. I won't say of the industry yet. We're not quite at constitutional levels, but this is the piece of work that we're going to be chatting a bit more about. So why we sort of did this, just to recap, the full value of nature is not included in decision making at the moment, and it simply needs to be if we're to make better decisions on nature loss. Traditional finance will play a critical role, and that is really what traditional finance has been telling us to help them figure out. And then on that note, investors need guidance. So the key question we asked ourselves in this work, or rather the key question that investors set us in this work was, what are the most relevant finance solutions, so instruments and capital sources, that can help investors deliver returns as a prerequisite, price in better outcomes for nature, and do so at scale. Not something that's bespoke, but something that can unlock a market. And that's, again, where we've decided to come in. And I'll give you maybe a bit of background to help us think through some of our questions and some of our concerns in this area. So we undertook a very deep review of the sector of sort of finance solutions for nature. And we found 39 solutions, consolidated quite a bit, but 39 in total. There are a few that focus purely on returns, which you see up there. There's a few that are concessionary in nature, so they can be deployed on their own, but they are also primarily used to sort of de-risk markets. There's policy-focused solutions, which are interesting. We're not going to focus on them in this session, but it definitely has an important role in the transition. And then there's solutions that cut across, which you can't really neatly fit into one category. So there's some that are both returns and concessionary. There's some that are returns and policy-focused. The biggest one that most of us know is debt for nature swaps. And there's some that straddle everything. Oops. And what we basically did from here was, going back to the key question, we decided to prioritize where we should focus our attention. And we did so on scalability, which we then broke down into 3 constituent criteria, and then nature impact, which we also broke down into 3 constituent criteria. And I won't spend too much time on this. There'll be much more in a couple of months to read, but at the end of the day, we came down to 10 priority solutions that we're going to be exploring a bit more. Now, I'm very glad that this is the morning and you folks have some energy. So get ready to stand up and stand down a little bit. I'm going to go through each of these one by one and ask if you are aware of these solutions. So if you're aware of sustainability-linked bonds, please stand up. I'll save my panel the ability to not do that. Okay, fantastic. That's about 90% of the room. Stay standing if you're familiar with use of proceeds bonds or thematic bonds or GSS plus bonds. Okay, about 80% of the room now. How about sustainability-linked loans? A few more getting back up. Clearly, the SLs have a hold on this room. How about thematic loans? So GSS plus loans or anything that you can basically go for a project. Interesting. And impact funds. Okay. Again, back to 90% of the room. Now, the next half is going to be very interesting. Who here knows about natural asset companies? Okay, that's more than I expected. Well done. How about environmental credits? So that's biodiversity credits, water credits, nature-based carbon credits, shall we say. Okay. Debt for nature swaps. Interesting. Okay, cool. Payments for ecosystem services? Gotcha. And internal nature pricing? Okay, again, more than what I expected. And Martina, of course, who's helped us from McKinsey develop this report. I won't count your responses, Martina. But thank you very much for that. And look, this is a good point at which to go into the panel, but just to preview sort of what we'll be discussing, we can go into a lot of detail on how these instruments, these solutions, are able to answer that scalability and nature impact question. But I'm going to pause the presentation over here. That's more than enough from me, and let's go straight to the panel. We are quite lucky to have a panel that's as stacked as this one, so let me introduce them all one by one. So we've got Claire from TNC, who's their Global Managing Director on the Tackling Climate Program. We've got Rob from Oliver Wyman, who's a partner focusing on the insurance and asset management industry in their climate and sustainability area. We've got Saskia from the World Bank, who is their Global Practice Manager on Financial Stability and Integrity. We've got Danny, who is a treasured colleague of mine from the World Economic Forum. She's the head of finance sector engagement at the Tropical Forest Alliance. We've got Pedro, who is the founder and CEO of Sustainable Investment Management. And I'm afraid you're stuck with me for a little bit, but less from here on in. So I'm going to take this seat now. Is this still audible? Awesome. So let's go into the questions now right away, and maybe let's pick up where we left off. So the first question that we're going to ask all of our panelists is, which of these solutions are you most familiar with? And we've seen examples of successful transactions pretty much in each of these areas. So I'd like you to also mention maybe from your experience what you've seen. And let's spend maybe 3 or 4 minutes per panel member on this question, because that'll really help set us up well. And Pedro, I was hoping I could start with you, because I remember when we first spoke about this, you were taking a look at the list and you were saying, wow, it's good to see I've worked on so many of them. So let's start from there. Pedro, over to you.
Thanks, Shivin. I'm trying to figure out if I did work with a lot of them, because it all depends on how you define that. But the one that I'm most familiar with is, well, just backtracking. Just last night we were talking about the effectiveness of some of those, the more generic sustainability-linked bonds, which kind of more difficult for you to ascertain exactly and monitor and see the KPIs and the impacts, versus the thematic bonds, which is what I'm mostly involved with. At the moment, sustainable investment management was created really to create thematic bonds for different kind of, sustainability objectives. The one that we are currently running is called the Responsible Commodities Facility. It is a green bond fund to finance sustainable or zero deforestation soy production in Brazil. Why soy? Why zero deforestation? Because soy is the main driver of deforestation in Brazil. And the approach that we take is really it's like an indirect conservation of Cerrado. We go to farmers that have, soy farmers that have access or that manage excess native vegetation, so more native vegetation than they are expected to maintain in their farms, and we give them low-interest credit lines. They can only access these low-interest credit lines if they commit not to expanding into the native vegetation surrounding their farms. Why low interest? Because interest rates in Brazil are really high. I mean, the base rate is 15%. It's not unusual to see farmers borrowing money at 20–25% per year, and they have to borrow money every year. They go to the banks every year. It's a 30 billion credit market to borrow money to buy the seeds and fertilizers that they need to plant. It's an annual crop. At the end of the year, they harvest. They pay back their loans. So the fund is going on for the last 4 years. This is the 4th year, and we're actually closing the round of finance now. We started that, we designed this fund really for the supply chain actors, for the UK supermarkets that have soy in their supply chain. Tesco, Waitrose, and Waitrose, Sainsbury's. They were the first ones to invest in that, and in subsequent years, then we brought a mezzanine tranche with an impact investment fund called Agri3. Then we bought Santander and Rabobank, and this year, just this very week, we will be closing the next round, which will bring it to about $60 million with the involvement now of the UK, Mobilising Finance for Forests, and which is run by the Dutch FMO, as well as Rabobank. So those are the new. No, Rabobank is there. Who else is coming? IDB. IDB is also investing in the senior tranche. So what else can be said about that? I mean, the biggest challenge that we face is always kind of raising the more junior tranches. I mean, we were talking at coffee today that we go to so many conferences that say, hey, the biggest, we have to find ways of unleashing private sector investment into nature. Hey, that's the easy part. The difficult part is really to attract public sector capital, especially for the more junior tranches that are needed for you then to pile up the private sector capital on top. So this is the one that I have most experience on, Shivin, and so I'll leave it at that.
Thank you, Pedro. That's a really good way to kick us off. And actually, I'm going to turn to Saskia next, because I think there's going to be a bit of link between what Pedro has also mentioned. Saskia, over to you.
Thank you. So thank you, and a pleasure to be here, because as the World Bank Group, as our mission is ending extreme poverty and boosting prosperity on a livable planet, a lot of the work that we do in terms of achieving green, resilient, and inclusive development, especially in these EMDEs where people are often very reliant on nature services and are very vulnerable to the depletion. It's very core to what we do. So we support client countries in several ways, and I'll touch base as regards in more detail for a few of them. So as regards our nature finance work, that is intended to really integrate natural capital and environmental sustainability considerations into the financial sector. And we do that in two ways. First of all, in terms of greening finance, where we work on achieving better data, but also, for example, assessments of nature-related risks to financial systems in countries where we as the World Bank are, for example, leading work on nature scenarios. And all that will help align financial portfolios with nature objectives, as well as mobilizing private finance for nature, so financing green. We do a lot of direct financing of biodiversity. I think we are the largest multilateral financier, and we offer a range of financial instruments and tools. So just to zoom in on a few of the more novel ones that are also in your list, for example, sustainability-linked financing. Look, performance-based financial instruments, which only pay out after key performance indicators are attained, have been gaining attention globally, and we see a recent growth in demand for both sustainability-linked loans and bonds. So some of our World Bank clients are showing growing interest, especially in Africa. So one example is Côte d'Ivoire. There we recently launched a sustainability-linked financing framework, and that ties borrowing cost to achieving targets in renewable energy and forestry. And if the goals of the government are exceeded, then interest rates decrease, and if they are unmet, then rates increase. So Côte d'Ivoire has very specific goals here in terms of boosting renewable energy capacity from 1 to 11% and to limit forest cover loss to 300,000 hectares, as well as reforesting. And through that framework, it aims to secure a sustainability-linked loan from commercial lenders. And in that, it's also supported by a credit enhancement from MIGA, our guarantee branch. So that also helps a bit with the loan tranches. And as well, to ensure the credibility and impact of the targets, the framework uses the new World Bank Feasibility and Ambitiousness Assessment, or FAB methodology. And I'll mention that in a bit more detail later. So it's very novel in terms of it marking the first use of combined IBRD and MIGA guarantee products to help solve these issues. Then also to mention outcome bonds. So we provide outcome bonds as well, which help mobilize capital and transfer project performance risk to investors. So some advantages of those types of outcome bonds for investors are that they are labeled nature sustainable development investments that helps support specific projects. There's a potential yield enhancement compared to ordinary IBRD bonds. And again, there's also credit enhancement through the full or the partial protection from us as the World Bank through our high rating. However, I would say, as in terms of outcome bonds, the scale is quite small because usually it's only the coupon that is directed to the projects. So these types of bonds are more useful, I would say, for niche, small-scale projects and for raising awareness for nature-related specific issues. So just to mention two recent examples, we did a reforestation-linked bond as regards the Amazon. That is the largest outcome bond that we have currently. It's for 225 million. It's principal protected, and it provides investors with a coupon that it both includes a fixed guaranteed component and a variable component linked to the generation of carbon removal units from reforestation projects in the rainforest. And in that sense, it's the first bond that links the return to the removal of carbon from the atmosphere, which is different from past transactions which were linked to the sale of carbon credits, for example. Another example is the wildlife conservation bond we did. It's also sometimes dubbed the rhino bond. That's for 150 million. And it was the first of its kind outcome-based bond that channeled capital to conservation activities. So investors would not receive coupon payments. Instead, the World Bank makes those conservation investment payments to two protected conservation sites to fund rhino conservation activities. And investors actually receive a success payment at maturity linked to the growth rate of the black rhino population at these two parks. And that was paid for by the World Bank with external funds. Then maybe one final thought. You mentioned debt for nature swaps. We are active in that debt for development space. So for example, also in Côte d'Ivoire, we did a debt for development swap for education. And that is something that could be replicated, including for nature. So debt for nature swaps could be a useful tool where there is partial debt forgiveness in return for nature conservation commitments. But again, I would say the market is still small because of the complexity of transactions. There's high monitoring costs. Mostly it's a small part of overall debt. So I think those swaps may be appropriate when debt is indeed not sustainable and the country needs some light debt relief, when grants are not available and the political economy is appropriate. But some potential drawbacks are that these debt for nature or climate swaps may be just as risky if countries do not deliver on their committed climate investments or nature investments. And including a swap in debt restructuring can enhance the complexity of the process. So for low capacity countries, that is a significant burden. Also, maybe swaps can lead to a negative perception that the country is unable to repay debt in a bigger sense. So there's some stigma there as well. I'll stop. Thank you.
Thank you very much. That's a very good overview of quite a few of them. So thanks for that, Saskia. Claire, maybe let me turn to you next. Same question. Which ones are you sort of most familiar with in TNC's experience?
Thanks. So the Nature Conservancy, I'll just spell it out because it's not very well known in Europe, is working in 70 odd countries, but 90 with 3 partners. And our mission is all about nature, but what my role is to make sure we're maximising climate in our work. And globally, half of GDP is reliant on nature. But nature is also a third of the natural climate solutions for carbon, and without nature, our overshoot will be bigger and longer. But nature is also the most flexible and cost-effective approach to adapt to climate impacts. So for all of these reasons, we're really trying to bring these agendas together. We have been doing a range of across that list of yours, we're probably involved in some experimentation with a government or a corporate on just about all of those. But the 4 I'll just sort of pull out as ones that we really think have got great scaling potential. The first is nature bonds. And unlike the bank approach, we're looking at commercial debt. And what we're looking to do is to refinance commercial debt, and the funding saved can then be deployed for purpose that the government sets out. And we set out a set of milestones and work with them then in delivery, bringing together their country partners to actually achieve those outcomes. So far, we've done 6. 5 of them are blue bonds, effectively, and 1 is terrestrial in Ecuador, which is working with indigenous peoples in the Ecuadorian, what they're calling their bioeconomy corridor. And that 1 million mobilized is an impressive amount, but it is a lot of work to deliver them. So this isn't, this is about finding a way of structuring long-term finance behind long-term ambition. And it's not worth doing if you're doing it for a short period of time or for a small ambition. It has to actually really make sense for their climate and nature strategies. The other is more around the sort of impact funds, where we've been looking at different sectors where there's challenges or different landscapes and trying to bring together stakeholders around an incentive system. So government sets policy. In the case of Brazil, it could be the requirement, the forest, what's it called? The forest requirement. I can't remember what it's called. Sorry?
Forest Code.
Forest Code, thank you, which requires agricultural or ranchers to have a certain amount of forest on their land, and setting up a means to incentivize that if you have that level or go above, as Pedro said, you get cheaper, longer-term loans. We've done something similar in Africa during COVID, where a lot of the tourism was really in trouble, no one was moving. So we provided longer tenure, cheaper financing to wildlife companies and including sort of real community-based wildlife organisations to help them through that period, but also to help them invest in ways that made it lower carbon, more adaptive, and more supportive of generating local jobs. A third area is around market shaping. So we very often are in a landscape where you've got high levels of mangrove or high forest, low deforestation, and the communities and the enterprises within that landscape benefit very little from what they're producing. So we're trying to shift that and working with, you know, the G20 has really been focusing on bioeconomy. We're trying to get really into the detail of how do you support enterprise that is genuinely mangrove positive or genuinely high forest positive, and how to support communities and their enterprises. But there are some really high value products, and those are not labelled necessarily. They're not really getting the recognition from where they're coming from when it is nature and climate positive. So we're trying to, we've got a variety of different funds. BC Plus is one of them, which is all about mangroves. And then we're just working on one which is currently poorly called the Indigenous Peoples-Led Enterprise Catalyst. But we'll have a better name by the time it's launched. But the point is that you are going into, drilling into great detail with stakeholders to really understand how do you set up a financial structure that incentivizes the sort of enterprise that we want to see flourish. And then finally, because it's not on your list, I'm adding it, is the work we do around de-risking through parametric insurance. So looking at a jurisdiction, a landscape, or looking at mortgages, for example, and the insurance you have to have with that, how do you actually value nature and the role nature plays in de-risking the investments in that area or the property in that area? So that's the fourth area. Happy to go into all of those in more detail, but I guess the point of what we're trying to do at TNC is we have NatureVest, which is a commercial investment arm internally to the organisation, working with us through these problems. And we also have an endowment fund where we invest our own money behind our mission. So we're really trying to bring financial acumen to the heart of the climate and nature strategies.
Terrific. Thank you so much, Claire. And you're helping me tee up the next one very well, because I wanted to go to Rob next. And Rob, in your view, which ones are you sort of most familiar with through the work that you do?
Yeah, I'd love to say I'm deeply familiar with all those exotic instruments that you had up on the, but I think the reality is my experience is probably more at the kind of the conventional end of things. So you mentioned the work that we've been doing with the forum on nature positive finance, and that really starts from the recognition that of about $7 trillion a year of nature negative investments, 5 trillion of those are made by companies within their value chains and operations. And so a lot of the work that we're doing is thinking about how we can redirect that $5 trillion a year of capex essentially to things that are at least nature neutral, ideally nature positive. There's two parts to that. One part is, if any of you were in the transition plan session earlier today, thinking about how financial institutions can assess companies based upon the credibility of their nature transition plans, allowing them to ultimately steer their portfolios more towards companies that have credible plans for reducing their impacts on nature. And we produced a report with the forum in April that sets out a framework for how that can be done. That, of course, lends itself to basically conventional equity, conventional lending, steering conventional portfolios, possibly also sustainability-linked instruments as well. But huge volumes of capital potentially to be moved there. The other piece is around specific projects. So where are there transformative projects or technologies that need innovative capital financing frameworks developed to prove them and scale them and roll them out? There, of course, you're looking more at use of proceeds, instruments, thematics. But again, you get into a lot of more familiar instruments. There's guarantees, there's specialty insurance to de-risk off-takes, there's some private capital as well. So I think those are the sorts of instruments that we're most familiar with in the work that we're doing with yourself and financial institutions. And I think my main takeaway from that is that there's there's a huge amount of the toolkit that's probably already available and is already at scale, and people already know how to work with. And we often get caught up in all of the exotic, exciting stuff, but a lot of that actually is focused, in my experience, outside of company value chains, and is possibly a little bit harder to get off the ground and get moving with. So yeah, I guess I'm being a little bit boring and traditional in my answer, but that would be my response.
No, not at all. I think the good thing about some of these new instruments is that even their structures they're trying to be a bit more familiar to investors, and we'll get into that. But I'm keen to sort of round up this first question with you, Danny. We started with someone from the Global South. We're going to end with someone from the Global South. By the way, I'm very pleased that this panel has got folks that are 50% Global South, and actually everyone here does probably work with the Global South as well. So I'm very happy to represent that perspective on an issue that's really, really critical to that part of the world. Danny, over to you.
Well, thank you very much. Can you hear me? So yes, I think before I go into financial instruments, I'm just going to explain a little bit what the Tropical Forest Alliance does. As Shivin mentioned, we have these 10 centers. I am part of the Center for Nature and Climate as well, together with Shivin. And within this center, we have a number of different initiatives, the Tropical Forest Alliance being one of them. And we were set up over 10 years ago to help companies to address the issue of commodity production linked to deforestation. So very much like I work very closely with Pedro, I work very closely with TNC as well. And I came to the initiative to bring the financial sector. So initially it was just the supply chain companies, so the CGF companies, the traders, governments and all of that, and finance was the missing bit. Within this context, what we are trying to do to address this issue, because I don't think deforestation is an environmental issue. It's economic, it's cultural, it's a much more challenging that everyone actually considers. And the challenges vary depending on the commodity we're talking about the region and all of that. So I think my first, going a little bit and answering your question, is I don't think there is one instrument that's going to fit all. Unfortunately, everyone is trying to simplify. Simplification to address such a challenge issue is not possible. So perseverance and patience is required, as we were talking a little bit earlier. But going back a little bit to what we did to try to take a systemic approach, we set up 3 different projects. One of them is called Investor Policy Dialogue on Deforestation. This is a group of approximately 90 pension funds and asset managers from 22 countries, and they have been in dialogue with government in Brazil, in Indonesia, and what we call the consumer countries, so UK, EU, US, and we're going to approach China very soon as well. And why I'm highlighting this here, because it is complex, and I think we all operate in silos. So having the capital markets speaking to governments, this is so important. We speak completely different language. They have different roles, and they have different limitations. So via this dialogue, I think there is a lot of knowledge coming out there and being shared between public and private sector. The second project which we're working, and Pedro is part of that, and TNC is a part of the project, is called Innovative Finance for the Amazon, Cerrado, and Chaco. Here, what we're trying to do, again, is breaking the silo. We have a producers advisory group, because I think producers are usually forgotten from this conversation, and they are the decision maker. If they are not providing input, nothing is going to work. That is as simple as that. And as Pedro mentioned, in Brazil we have a very strong forest code, and the world is asking Brazil, go beyond your national regulation. And I like to give the example that a producer in Amazon, they need to protect 80% of their lands, and they can only produce in 20. At the same time, they go to a bank to get some money, and the forest has no economic value. There is no warranty for what they have in forest, but just agricultural production land, pretty much. That is a major issue. When you go to what Pedro is doing, the node is a little bit more flexible, and they are required to conserve 40%. Again, you have a 5-bedroom house, and the world is asking you to lock 2 bedrooms for the sake of the world. they need to receive for that back. So what RCF is doing hits exactly on that spot. We need to compensate somehow as well. And what we try to do is bringing all the stakeholders, producers, supply chain companies, asset managers, banks, providers of catalytic finance to really work together and develop new instruments. We launched this initiative at COP26. Since the launch, these 24 signatories, this massive group of stakeholders that I just mentioned to you, committed to 5 billion investments to support the transition of the cattle sector, the soya sector, and we have recently added agroforestry and sustainable management of non-timber forest products. The latter two, because they're very important to support the transition. The cattle rancher is in the Amazon. That's how they live. They need a transition plan. They need a transition activity as well. And I think the exciting bit is that since we launched, 17 financial instruments have been developed, and there is a variety of instruments such as the one that Pedro mentioned. There is long-term loans as well with grace period for producers who have to restore and then produce. They need time to restore the lands and then expand the production in already degraded lands. And there is a lot of products which are supporting the bioeconomy agenda. And again, I don't like to use bioeconomy because bioeconomy can mean anything. So that's why we selected agroforestry and sustainable management of non-timber forest products. And finally, so I think this is quite exciting. We are seeing a lot of that, but there is the need for the catalytic, the risking capital, and that is a massive challenge. Now we are working with Vox Capital, which is also a signatory of this initiative, to structure a fund which is called Catalytic Capital for Agricultural Transition. We call it CCAT. And at the moment, we are trying to do the fundraising. And as already mentioned, the bad thing about being the last person is because a lot of things have been mentioned, but I can re-emphasize. Fundraising, bringing public money, bringing philanthropic money to support the transition of such a high-risk sector in a high-risk region is also a challenge. We're doing well. We've got already more foundation from the US, which committed to 20 million to support this fund. And we are hoping to launch it at COP, which is a much bigger support. We're doing, hopefully, fingers crossed, it's going to work. And what we want to do there is scale. Again, scale depends on the definition of what you mean of scale. And I think finally, just to try to connect the dots, I'm also working with a group of commercial banks, from 10 of them across the world, but a lot of them US, UK, and all of that. And one thing that is very interesting, and I like the boring traditional, is because we recently had some conversation between the banks, supply chain companies, and investors, institutional investors. And the feedback that we had is outcomes-based. It is still the preferred because of transparency. We are seeing a huge issuance of sustainability-linked bonds, which is great because plain vanilla is much easier, but there is a huge risk in terms of regulatory risk, reputational risk, because there is lack of data, and investors cannot monitor where they're going. So, like I said, I don't think there is one size fits all. It is complex, and we need to find different solutions, which are gonna, again, supply chain is quite diverse, and each part of the supply chain only has, they also have their limitations, and also we need specific instruments to address different issues.
Awesome. Thank you, Danny. And thank you, everyone, for your answers to that first piece. And we've got about 15 or so minutes on the panel still left, so I'm going to now get to a bit more of an urgent mindset. And we're going to do two things, and I'm going to volunteer some intent on behalf of the audience. And I'm not going to ask anyone to speak just yet. And the first intent, and the question and the lead up to that, and Danny, you touched upon this a little bit. You said, folks are requesting the Brazilian sectors to go beyond what is required in the national regulation, right? So I'm going to go on behalf of the asset managers, the asset owners, and the issuers in the room and say they buy into that. They want us to go beyond, right? They want us to find the right instruments, the right structures that can help incentivize better outcomes for nature. Right? That's the premise for this next question. These guys. Let's assume that. So based on that, here's a question for a few of you, which is, what are the instruments and structures that can best incentivize the right outcomes for nature? And Claire, maybe let me go to you first on this one, and let's keep the answers to about maybe a couple of minutes each.
Okay, I'll try and be brief. I actually have 7 things that I think, because I don't think it's as simple as you do this one thing and it's a magic bullet and it changes the ecosystem. You actually have to be pressing the button on loads of different levels. So first of all, the role of insurance. I think we could be using insurance much more to price the cost of good management and restoration of nature to lower risks for the economy as a whole and for society as a whole. And that requires regulatory action to requiring the insurance industry to consider systemic risks, because otherwise it just doesn't make sense for any insurer. Secondly, I think we have this big fight going on at the moment. If you're not aware, please join us in fighting for nature in carbon markets. At the moment, this idea of permanence means that we will not be able to, it'll mean our overshoot is bigger and longer because we're not using the most cost-effective and fastest thing we can do today because we're waiting for a more permanent solution that isn't ready yet. So we need nature in carbon markets, and there's a big opportunity to price the co-benefits of nature restoration and adaptation into high-integrity carbon credits. The third is around how do we incentivize the products and the commodities coming from places where they have done the restoration, and we need to find ways of doing that, and I think the Brazil example is just fabulous to show the rest of the world how to do this, thinking about all of the different actors and all of the different incentive systems, so that landscape level. The fourth is tax credits. We saw what the IRA did for the US. We've lost some of it, but we've kept some of it, and those types of techniques can have huge impacts for the business case for the type of investment we want. Policy like biodiversity net gain would be my fifth one. Sixth is subsidy reform. Again, the UK's got a good example where they said public money for public goods, and our agricultural subsidy system now is all about nature restoration, or largely, it has a big component. And then finally, how we rate credit and debt and the sustainability of that. We've seen the importance of, well, S&P did that great study on lost GDP, how much you are losing because of climate impacts. Until we begin to get that being core part of government's assessments. So I'm really hoping that the new debt sustainability framework that the IMF World Bank are working on will put nature at the heart of that alongside climate. And I guess the sort of big opportunity also is around investor protection treaties, which at the moment reward investors and stop governments from taking action to do the right things. And I'm not going to go into the detail of that. It's quite technical, but it's really important.
That was one of the most efficient answers I have ever heard on a panel. That was amazing. 7 things, if I've got them right: insurance, carbon markets, products and commodities, tax credits, smart policy, subsidy reform, and ratings. You're amazing, Claire. Thank you for that. Maybe let me ask the same question now to you, Rob. Let's get your take on it. I know it's a slightly interesting one.
Yeah, so at the risk of sounding a little bit heretical, I worry about the tension, if you like, between scalability and I guess kind of accuracy and kind of pricing in nature or incentivizing the perfect outcomes. And I worry that there's a risk of letting the perfect be the enemy of the good. So let me explain. A lot of the time, we know what we need to do and what we need to stop doing. And it's relatively easy to stop financing the bad stuff and start financing the good stuff. We don't necessarily need the perfect MRV framework, the perfect metrics, a price on these different outcomes. And we've kind of seen this already with climate change, which is a much simpler problem in many ways. We have one metric, which is emissions, and we can set an internal carbon price. But I would argue a lot of the capital mobilization that has happened in the private sector is not in response to internal carbon prices and financed emissions metrics. It's in response to knowing the things that we need to finance and the things that we need to stop financing and setting relatively straightforward targets around them and using relatively straightforward instruments in connection with them. And so I would say let's not kind of forget that when we're talking about this agenda. And it's not to say that I think trying to price in nature and get the incentives perfectly aligned is a bad idea. It's a very good idea, but it's potentially very difficult to do. Like, how long have we been working now on valuing natural capital and pricing ecosystem services for like 20 years? And we're still kind of, in a lot of cases, tinkering at the margins with this stuff, so.
30, yeah, exactly. It's UNSEA was, that's a system of economic environmental accounting for those accounting nerds out here, of which I am a proud one. 1992, pretty much the same age as the Rio Conventions. It takes, if the experience of GDP is anything to go by, an analog for that, say gross ecosystem product, might take 50 years to go through. We don't have that luxury of time. If anyone was in Oxford 3 days ago, you were burning. You don't have that time. Perfect is the enemy of the good. Pedro, over to you on that motion.
I couldn't agree more, Rob. I think that we are, actually my plea here would be for simplicity. But basically, I mean, it's a challenge. How do you incentivize kind of nature, enhancement, protection, a shift in behavior of those that interact with nature? In general, if you get forest conservation, it does not generate a revenue. So how do you attract investment for something that does not generate a revenue for you to pay your investors? It's always been a challenge. I mean, in the olden days when I was a kid trying to finance conservation, you're looking for grants. Grants are always limited. They're small, great demonstration projects, but it can't be scaled. When carbon first arose, I mean, I ran the very first carbon-funded project in the world back in 1991, before the Rio Summit. We were starting a project in Malaysia, ironically. Me being Brazilian, I was in the Malaysian rainforest, and spent my whole career believing that, hey, this is a great mechanism. You can mobilize private sector capital directly into projects on the ground. It shifts the dynamics of the donor and the recipient, passing the hat. We are both kind of equal in a commercial transaction. And I spent years on that. I used to have a company here in Oxford that had 700 CDM projects around the world. World Bank was one of my first clients, actually, in the Prototype Carbon Fund. But carbon is, going back to the simplicity and the pursuit of perfection that Rob mentioned, we have, over the last years, over-engineered carbon to an extent that is non-scalable anymore. I mean, the voluntary carbon markets 2 years ago was $2 billion. Last year, $1 billion. The previous, and the last year, $500 million. For comparison, the market for chewing gum worldwide is $23 billion. We're definitely putting our money where our mouth is. Then, back in 2018, so I was really involved with Cerrado and soy deforestation. Soy, the biggest driver of deforestation in Brazil. How can we protect this native vegetation that is there? And the farmers attempted to expand into that because there's great demand for soy coming from China and Europe. So that's when I thought, oh, perhaps let's look at a different mechanism. Green bonds may be a good way of doing that. We raise money abroad. We try to reduce cost of capital. We have to make it commercial as opposed to concessional so that it can be scaled. And that resulted in the fund that I mentioned before. I thought it would be easier than the over-engineered carbon markets. But when you blend in finance, God, is a nightmare. It's, the amount of requirements from one party versus other parties, especially when they are DFIs, they may have a whole list of requirements. Some of them are even contradictory between themselves. So, we need really to think about that. Do we need more complexity? Does this complexity reduce a risk? Does this complexity give you a better financial outcome. I know that lawyers and consultants make a field day out of complexity, but in detriment of what could be going to the field. So scalability, which was a point that was raised, in my view, would depend on two things. I mean, and you ask what would be the most promising instrument. It's one that is commercial, so that you can attract capital at scale. So you have to figure out, a financial engineer has to make it, that you have something that institutional investors can put money and get a financial return. And second, we need to aim for simplicity. I mean, the world is too complex at the moment for you to be able to navigate these things and make them work at the scale that we need. Just to finalize, I'll give this pursuit of simplicity, actually, was exactly what drove me and a small group in Brazil to figure out a new mechanism to protect forests worldwide that didn't depend on the constructs of the carbon credits, which is additionality, leakage, permanence, a lot of requirements that nearly impossible to demonstrate or promise. And that we came up with something new that became what is now called the Tropical Forest Forever Fund, that the World Bank is taking it forward. But the whole point there is, can we figure out a simpler mechanism to attract and deploy capital to forests, to protection of tropical forests around the world in a much simpler way than we've been seeing with other instruments. So I just wanted to close with that.
Thank you, Pedro. But well, Pedro started that answer with a plea for simplicity. I'm going to make a plea to all of you. Remember everything that he said, just don't remember the chewing gum fact, please. Like, that, don't let that marvelous one-liner distract you from everything that he's just said. And Pedro, you've actually started us on the last question already, which is, I'm very grateful for that. And let's volunteer something else from the audience in terms of intention, which is they don't want to invest in something necessarily bespoke. They want to invest in something that can get scale, right? We want to all be working towards the sort of same mission. We don't want to be spending our precious time and resources on things that may work if they are perfected, but won't work necessarily, as you say, in the urgency that we need. So that's the question now. And Saskia, I want to turn to you on that theme.
Scalability. Yeah, no, and I agree, because in discussing those innovative products, I already mentioned some pros and cons in terms of the scalability. So what do we do as World Bank to really promote scalability? Well, for example, what we also do is try and work on the ecosystem required for new development and structurings, etc. So we work on tools and frameworks to help support the development of nature-related instruments. Maybe one to mention is the feasibility and ambitiousness dashboard that I briefly touched upon. So what we see is that many sovereign issuers struggle with KPI setting, including because of the complexity, the lack of baselines, lack of comparables for calibration purposes. So what we did is we developed a model to contribute to the robustness of those KPI frameworks, to be used both in sustainability-linked loans and bonds. And that gives more structure to the target setting exercise. So what the FAB matrix does, it gauges targets along feasibility and ambitiousness. And it utilizes data that is observable and uses peer groups of countries as a baseline to measure whether a KPI is feasible and ambitious. So ambitiousness relates to whether a target falls within the range of a business as usual scenario or exceeds such expectations and would require a significant policy effort on behalf of the country. And feasibility actually relates to historical precedents showing that a target like that can be reached. So it looks for cases of progress historically needed in a country to reach a target. So if many peer countries have made similar progress in the past as is necessary to achieve the target, then it would be considered highly feasible. And in order to do all that, the FAB model works with our sovereign ESG data portal, which has about 200 indicators across all countries with data going back at least 20 years for each. So just to mention one example to introduce that scalability as an option and have things more simple. Other examples can include the MDB Nature Finance Tracking collaboration, and for example, also some work we've been doing on natural capital accounting with client countries. We are also actively supporting EMDEs in their efforts to improve data availability. And for example, the World Bank provides natural capital data in its flagship publication, Changing Wealth of Nations, to help expand coverage and measurements of capital assets. And that's just one example. We also have a sovereign ESG data portal, as mentioned, and a biodiversity finance reference guide issued by the IFC. So maybe to echo what Claire said, there is no one-size-fits-all solution. That's also why I touched upon different instruments and their pros and their cons. And we need to keep innovating in order to have the right tools, data, and instruments available. One thing I would mention, in addition to what we're doing to try and improve that ecosystem and hence facilitate scalability, is that those sustainably linked instruments are gaining momentum with sovereigns in EMDEs. And this market is still developing and expanding, which offers an opportunity to develop more nature-specific KPIs. And while we see that most investors are most familiar with and comfortable with use of proceeds bonds, such as green bonds, I would say that these types of products have several key advantages, including flexibility, because of them being less earmarked, the limited costs. They do require a framework, like I described in the case of Côte d'Ivoire, but then you can use that framework for multiple issuances. It's also a way to showcase progress. I mean, many MDEs do have robust sustainable development strategies and targets, so it's a way to showcase those and help lock them in. They can help tap a wide range of investors. And finally, and that's important, you can use credit enhancement in these products. So where many sovereigns are below investment grade, and SLL format is actually increasingly interesting, as we can incorporate credit enhancement in the product, and also use donor support and performance-based grant financing can be built in. I'll stop there. Thanks.
Awesome. Thank you for that, Saskia. And for those who haven't read The Changing Wealth of Nations, here's a shout out. Do it this weekend or next week if you can. It is really a new worldview into what a systems change of macroeconomic thinking could look like. And I'll leave you with a question for that. Like, imagine a world in which we go through wealth-based accounting. We don't have to work on it now, given the urgency of things, but there are people who are working really hard to make that happen. So thank you, Saskia, for that answer. Danny, maybe let me turn to you next on the question of scalability.
I think for me, the key, again, define scalability. I don't know what it means. I think I'm going to just ask a quick question to Pedro before I talk what I want to say, but can you talk a little bit about the impact in RCF in terms of the size of the land already? Because it's pretty impressive, I think.
Yeah, it's this year is about 50,000 hectares of native vegetation protected and about 18 megatons of carbon stored in this forests.
So it is scaling there already, don't know, to go beyond legal requirements. So it's not to the speed and to the amount that we need, but it's effective. But I think for me, the key of scalability is we need to make things simpler, as you said. I think we need to detach a little bit our agenda, sustainability, from politics. We need to insert it and stop talking about, and don't hate me for saying that, but nature, climate, the whole thing is completely politicized now. How can we detach from there? It's about resilience. It's about resilient economy. So I think we need to adjust our language a little bit as well to become a little bit more mainstream. And linked to that is like, how can we decrease the costs? So financial institutions can actually be more efficient to develop all these various instruments that we are talking here, take less time, and actually, achieve the scale at the speed that we need. So I think it's a little bit of a, yes, let's be less niche and more integrate our story into the broader narrative. I think this is really important now, because politics change, science is not changing, And markets are very strong. We saw that happening a few months ago, how the power of market is massive. So I think that is what needs to take. Not a recipe, but some, I think, systemic issues that we need to change how we are talking.
The science doesn't change.
No.
Take that away from Danny's remarks there. The science does not change. Okay, so Claire, maybe let me turn to you next on the question of scalability.
Yeah, I mean, I completely agree with the points around simplicity, and what we're aiming for is a world where it is the commercially most advantageous thing to do is to do the things that are climate and nature positive and good for the communities as well. The 3 Cs we've been calling it in TNC, communities, conservation and climate. But to get there actually requires us to do the things that might be a bit more complicated and take a bit of time, but we can't afford to keep trying. I mean, I used to work for the UK government. We were always looking for the magic bullets. We wanted magic bullets because our ministers wanted magic bullets. They wanted to stand up on stages and talk about magic bullets and put money into magic bullets and have big outcomes. And actually, you can create a lot of noise and a lot of process and not make very much progress. So I have decided to dive into complexity in order to provide simple solutions to other people and try and get that commercial finance in. So I think what I would ask for is for more of us to be prepared to live with a bit of complexity, try and hold this place where you're bringing the different stakeholders together to understand what the long-term commercial solution will be and how do we get there. And for more philanthropy and more of that limited public grant finance that is available to be used for that stage with a long sight on that commercial and simple solution at the end of it.
Wow, powerful. And maybe let's turn to Rob for the last word on this question. Rob, question of scalability. You touched upon a little bit on the previous one too.
Okay, yeah. So I'd say 3 things, and I think these are all implicit in what everybody's been saying. So standardization. So standardization of metrics, frameworks, MRV, whatever it is. And that can help, I guess, like lateral replicability. So we want to be able to do the same thing in a different sector or the same thing in a different country without having to kind of start again. Yeah. And then the third thing would be aggregatability, actually. So I don't have any data points for this, but my sense is that often a lot of the nature stuff is quite small in ticket size. And to really unlock large pools of capital, you need to be able to, and this is why you need standardization and replicability, you need to be aggregate these things up and probably securitize or something like that, right? So those would be the 3 things on my Christmas list for scaling nature finance.
Let me put another one in the Christmas list, which is, okay, Saskia was mentioning, the World Bank, and a lot of people in this room probably involved in kind of KPIs and ways of measuring these indicators and so on and so forth. If you open a coal mine, probably you have a lot less indicators. You want to see how much coal there is there, how much investment I need, and what is my revenue. So back to my plea for simplicity, we should not make investment in nature more difficult than investment in conventional energy or infrastructure and so on. Otherwise, we'll be shooting ourselves in the foot.
We have some very interesting Christmas stockings on this panel, I have to say. Right, so with maybe a couple of minutes on the panel portion of our session to go, we're going to ask one last question of each of our panel members. And this is a nice lead-in also to our breakout sessions, which we'll get to in a second. I wanted to ask each of you to make an ask of the room and an offer to the room. One ask, one offer, 30 seconds on what you can do together to solve the challenge of nature finance being perennially, there's perennially a gap from what is needed to what we have today. So an ask and an offer. Pedro, I wanted to give you the first word on this.
I think I already asked a lot. But
You've asked for simplicity, yes, okay.
Simplicity and what Rob just said, I mean, standardization, particularly when we're dealing with kind of blending different types of capital, we need to have more mutually agreed KPIs and ways of measuring them and so on and so forth. Otherwise, every time, it's really difficult.
Awesome. And your offer?
I can help you with that.
Gotcha. So call Pedro, that's the offer. Saskia, maybe you next.
Well, in terms of the offer, what the bank will continue doing is sharing, our experiences, the tools, the frameworks, everything that we develop, and notably as publicly as much as we can. So, for example, the methodology I mentioned for measuring the FAB methodology, as well as the sovereign ESG data portal, it's all public. So it's all on our website at Citra. In terms of the ask, well, for all stakeholders to continue, seeking those partnerships, collaborations, and we would welcome those very much. And also, get into the nitty-gritty design features of the right products and tools necessary to actually make progress. Yeah, thanks.
Thank you. Danny, an ask and an offer.
I think my ask is let's get out of the bubble and talk to each other because, as I said, I think everyone is just talking to their own peers. It is quite interesting to see how, in a dialogue, how much you learn from each other and how much you can contribute to each other. My offer is reach out to me because I love doing that. There we go.
The offer is your WhatsApp number.
My WhatsApp number, yeah.
You've got a private consulting panel up there, folks. I don't even need to do anything after this, so yeah, my job's done. But part of my job is to now ask Rob, what's your ask and your offer?
So, the professional consultant now.
Exactly. See, there's a theme to where we're traveling. Thank you, everyone, for doing this without any prompt from me. Rob.
So I think, if there were policymakers in the room, my ask would be to get going with MBSAPs and make them concrete and cascade them down into policy and regulation, because that's what's really going to start moving capital. And the example Claire gave of biodiversity net gain, the compliance mechanism, there's all sorts of things that are springing up around that: habitat banks, funds to invest in all of this stuff, insurance solutions to de-risk the credit issuance. So let's see more of that. And then, my offer, I'm a management consultant, so we're here to help. But I guess the commitment I would make is that, to make it simple. So, Pedro's point, we're not gonna make it overcomplicated. We've got to make this simple if we're gonna scale it.
Wonderful. Thank you for that, Rob. And Claire, last word to you.
So my ask would be for partnering in the early stage, messy realities of trying to find those simple solutions that are actually going to change things at a landscape level. And I think the IFAC, the Brazil example that we've been speaking to today, is just a perfect replicable model that we could be using globally. And we've seen something similar emerging in Mexico. We're working on some of this in Africa and in Asia. And if you get down to the landscape level and look at all of those different commodities, different opportunities, and then understand how do we incentivize the right thing, it actually isn't that complicated, but you'd have to do it at that landscape level. My offer then would be for TNC to be an honest collaborator, prepared to learn fast with you all and share how we're adjusting along the way, because the first solution is not always the right solution, and we need to keep nudging and improving. But I also think there's an ask just around how we reward experimentation. All the governments around the world at the moment, or so many of them, not all of them, are actually experimenting live in reality how to get this right. And quite often they are not being rewarded for the effort. And how can we do that so corporates and governments are rewarded, not penalized, for saying we're going to try and be ambitious?
Thank you, Claire. Folks, before we move to the breakouts, please join me in giving a round of applause to this fantastic panel.